Welcome to Tax Takes. My name is Gay Proberts-Camp. In this video, we will review the application of the capital gains tax rules to property disposals. As you watch this video, I recommend that you have your learning materials open so that you can highlight key sections and add your own notes. As you should know from your studies, the CGT event A1 is a CGT event that applies when there is a disposal of a CGT asset. A net capital gain is included in the taxpayer's assessable income under Section 1025. However, a net capital loss is carried forward and can be used to reduce capital gains in future years. Australian resident taxpayers are subject to tax on CGT events relating to their worldwide assets. However, a non-resident taxpayer is only taxable in Australia on CGT events happening to a CGT asset that is taxable Australian property, or TAP, for example, land and certain indirect investments in land. The inclusions and exclusions from the definition of taxable Australian property are explained in detail in your learning materials. You should also know from your studies that as the definition of a CGT asset is so broad, just about everything is included. Therefore, the scope of CGT is limited by the application of exemptions. The most common specific exemption for an individual taxpayer in Australia is the main residence exemption, or in other words, the exemption that applies to the individual taxpayer's family home. The main residence exemption can disregard all or part of a capital gain or loss. The extent of the exemption depends on how the taxpayer used their family home. The requirements for application of the main residence exemption are covered in detail in your learning materials. And finally, you should know that an individual taxpayer may be entitled to the 50% general discount. This discount can apply where the CGT asset has been held for more than 12 months and the CGT event occurs after the 21st of September 1999, provided the cost base of the asset has not been indexed. The requirements for application of the CGT 50% general discount are covered in detail in your learning materials. So let's consider an example for a resident taxpayer. In this example, John, an Australian resident taxpayer, sold some assets during the current income year and is not a small business entity. The assets disposed of are a rental property held for a number of years and sold at a profit of $500,000, depreciating fittings within the rental property that were all acquired new and sold at a loss of $30,000, and a non-depreciating artwork held for private purposes that was sold at a loss of $2,000. You are required to calculate John Smith's minimum net capital gain and explain any exclusions. Remember, calculate and explain are the same task words or verbs that were used to express what you need to do and to what depth. Calculate means you need to quantify your answer, and explain needs you need to provide a reason for any exclusions from your calculation. It is also important to note the other specific requirements of this example. As John Smith is not a small business entity, you cannot apply the SBE concessions. However, you need to minimise John's net capital gain. Therefore, in an exam, you would need to consider the choices and concessions available to the taxpayer. This would include considering the indexation method where the CGT asset was acquired before the 21st of September 1999. Where the taxpayer is an individual, both the indexation method and the discount method potentially apply. Where both methods are available, you should complete alternate calculation and then choose the method that gives you the lower overall capital gain. When calculating the minimum net capital gain, you should also exclude pre-CGT assets that were acquired before the 20th of September 1985, except where the specific pre-CGT asset integrity provisions apply. So let's review this solution. The rental property, the depreciating fittings, and the non-depreciating painting are all CGT assets. However, to calculate a capital gain or loss for each asset, you need to consider the exemptions and special rules that apply. As a rental property is not used as John's main residence, the main residence exemption is not relevant. And as the rental property was acquired after the 21st of September 1999, the indexation method is also not relevant. Therefore, John has a capital gain on disposal of the rental property of $500,000. The artwork is a collectible. As its cost is more than $500, the exemption under Section 118.10 to disregard a capital gain or loss does not apply. Therefore, John makes a capital loss on his disposal of $2,000. The loss is calculated as capital proceeds of $6,000 less reduced cost base of $8,000. In this example, cost base and reduced cost base are the same. The capital loss on disposal for the artwork must be quarantined under Section 108-10. This means that it can only be used to reduce capital gains on the disposal of another collectible in the current income year or a future income year. The loss on disposal of the depreciating assets will be disregarded under the anti-overlap exemption in section 118-24. The disposal of depreciating asset gives rise to an assessable or deductible balancing adjustment under Division 40, or the application of the Division 328 rules where the taxpayer is a small business entity that has chosen to apply the SBE capital allowance rules. You should also note that an individual taxpayer that is not carrying on a business is not entitled to claim a decline in value deduction in respect of second-hand depreciating assets acquired after the 1st of July 2017. Therefore, in that situation, CGT event K7 would happen at the time of their disposal. However, as all the depreciating assets owned by John were acquired new, CGT event K7 is not relevant. Once you've calculated the capital gain or loss for each asset, if any, you need to calculate the net capital gain for the current year following the steps in section 102-5. As the current year capital loss on the artwork is quarantined, it cannot be used to reduce the current year capital gain on the rental property. In addition, John does not have any carry forward capital losses that can be used to reduce the current year capital gain on the rental property. However, as John is an individual taxpayer and has held the rental property for more than 12 months, the capital gain on the disposal is a discount capital gain. This means that John is entitled to apply the CGT 50% general discount. Therefore, John has a net capital gain of $250,000. In an exam, don't forget to answer each part of the required task. In this example, you were also asked to provide an explanation of the exclusions. So let's further check your understanding. What if there was an additional fact in this question that John was entitled to claim a capital works deduction of $10,000 in respect to the rental property? What impact would this have on the capital gain calculation for the rental property? The correct answer is that under section 110-45, the cost base of the rental property would be reduced by the Division 43 capital works deduction as the asset was acquired after the 13th of May 1997. If the asset was acquired before this date, then no reduction would be required. You should also note that if John was a small business entity, you would also need to consider if he's eligible to apply any of the SBE CGT concessions. However, even if John was an SBE, he would not qualify for the SBE concessions for the above assets as they are not active assets. Okay, let's change the facts in a different way. What if there was an additional fact in this question that John, an Australian resident individual who made a capital gain on disposal of his rental property of $500,000, also had a carry forward capital loss of $100,000? What is John's minimum net capital gain? The correct answer is that John's net capital gain would be $200,000. The capital gain of $500,000 must be reduced by the capital loss of $100,000 before the CGT 50% general discount is applied. So even though John's capital loss was $100,000, the overall reduction in his net capital gain from the original facts of the example was only $50,000. What this shows is that to correctly calculate a net capital gain, you must follow the order of the steps set out in section 102-5. What this also shows is that an individual taxpayer would minimise their net capital gain by reducing capital losses and carry forward net capital losses against non-discount capital gains, that is, capital gains that do not qualify for the CGT 50% general discount, before reducing them against discount capital gains. You should also note that a company is not entitled to apply the CGT 50% general discount. Therefore, if the taxpayer in the above example was a company, the company's net capital gain would be $400,000 and not $200,000. So let's consider an example for a non-resident taxpayer. In this example, Jerry, a non-resident individual taxpayer, sold land located in Australia for $200,000. The facts also tell you that the land was acquired in the 2010 income year for $100,000 and had a market value on the 8th of May 2012 of $140,000. You are required to calculate Jerry's minimum net capital gain, if any. The task word once again is calculate, so you know in an exam that you need to quantify your answer and to maximise marks that you should show all your workings. You are also required to minimise the net capital gain, so in an exam you would also need to consider the method to apply that will give you the minimum net capital gain. Let's review the solution. The land is a CGT asset and CGT event A1 happens at the time of its disposal. However, to calculate a capital gain or loss for the asset, you need to consider the exemptions and special rules that may apply. As Jerry is a non-resident taxpayer, under Section 855-10, he is only subject to CGT in Australia on the disposal of CGT assets that are taxable Australian property or TAP. Taxable Australian property, as defined in Section 855-15, includes taxable Australian real property, or in other words, land and anything fixed to land like a building. Therefore, the capital gain on disposal of the land of $100,000 is not disregarded. As Jerry's capital gain is not disregarded, you need to calculate his net capital gain for the current income year following the steps in Section 102-5. Jerry does not have any current year or prior year capital losses. Therefore, the capital gain on disposal of the land is not reduced by a loss. However, as Jerry is an individual taxpayer and has held the land for more than 12 months, you need to determine if he is entitled to the CGT 50% general discount. A non-resident taxpayer is only entitled to the CGT 50% general discount for capital gains that accrued up to the 8th of May 2012. What this means is that Jerry must apportion or split his capital gain into the portion that accrued up to the 8th of May 2012 and the portion that accrued after this time to the date of his disposal. The simplest way of apportioning the capital gain is to use the land's market value on the 8th of May 2012. The capital gain for the period from 2010 when Jerry acquired the land to the 8th of May 2012 would be $40,000. This is calculated as the $140,000 market value as at the 8th of May 2012 less the $100,000 cost base of the land when it was acquired. The taxpayers entitled to the CGT discount is therefore 50% of $40,000, which is $20,000. Therefore, the total capital gain on disposal of $100,000 is reduced by the taxpayer's entitlement to the 50% general discount of $20,000, and the net capital gain would be $80,000. We'll now look at an example that considers the main residence exemption. In this example, Tom, an Australian resident individual, sold his main residence for $1.6 million. The main residence was purchased 8 years prior to its sale for $1 million. For the period of 4 years during his ownership, he used 20% of the floor space for an income-producing purpose and claimed an income tax deduction for 20% of his mortgage interest. You are required to calculate Tom's minimum net capital gain or loss. The task word, once again, is calculate, so you know in the exam that you need to quantify your answer and to maximise marks that you should show all workings. And the required also asks you to minimise the net capital gain. So, in an exam, you would also need to consider the method to apply that will give you the minimum capital gain. In this example, indexation is not relevant, as the home was purchased 8 years ago, which is after September of 1999. The key to answering this question is to consider the impact of the business use on the main residence exemption. So let's review the solution. The main residence is a CGT asset and CGT event A1 happens at the time of its disposal. However, to calculate a capital gain or loss for the asset, you need to consider the exemptions and special rules that may apply. The capital gain before considering any exemptions is $600,000. However, as this is Tom's main residence, you need to consider the application of the main residence exemption. The capital gain or loss from the family home is prima facie disregarded under Section 118-110 as the dwelling was owned by Tom, a resident individual, and it was Tom's main residence throughout the ownership period. However, as the dwelling was partly used for income-producing purposes at the same time as being Tom's main residence, and Tom has claimed a deduction for a proportion of the dwelling's ownership costs, for example, interest on a loan, council rates, or body corporate fees, the main residence exemption must be apportioned under Section 118-190. You should also note that if Tom had not claimed a deduction for a portion of the dwelling's ownership costs, but instead had limited his deductions to non-ownership costs that have a direct connection to the income-producing activity, for example, electricity and telephone costs, the main resident exemption would not need to be apportioned, or in other words, Tom would have been entitled to fully disregard the capital gain on disposal. But in this example, Tom cannot apply the main resident exemption to the extent the property is used for income-producing purposes. From the facts, you know that 20% of the property was used for income-producing purposes. However, that use only occurred during 4 of the 8 years during which the main residence was owned. Therefore, the portion of the capital gain that relates to income-producing use is $60,000. As Tom's capital gain is not fully disregarded under the main residence exemption, you need to calculate his net capital gain for the current income year following the steps in Section 102-5. Tom does not have any current year or prior year capital losses. Therefore, the portion of the capital gain related to income-producing use is not reduced by losses. However, as Tom is a resident individual taxpayer and has held the main residence for more than 12 months, the capital gain on disposal is a discount capital gain. This means that Tom is entitled to apply the CGT 50% general discount. Therefore, Tom's assessable net capital gain after application of the main residence exemption and the CGT 50% general discount is $30,000. The main residence exemption is further explained in Unit 4 of your learning materials and in Quick Reference Guide 4.5. So let's check your understanding by changing the facts. So what if in this example you had an additional fact that Tom had a carry forward loss of $30,000? What is Tom's net capital gain? The correct answer is that the capital loss would be offset against the $60,000 assessable portion of the capital gain before the CGT general discount is applied. Therefore, Tom's net capital gain would be $15,000 and not nil. Remember in an exam, if Tom also had non-discounted capital gains, to minimise the overall net capital gain, the carry forward loss should be offset against non-discounted capital gains first. So good luck with your studies, and I look forward to chatting with you again soon.